All right. Well, good afternoon, everybody. I hope everybody's enjoying this balmy August afternoon that we have. At least it feels that way. My name is Lee Schwartz. I am the Director of Business Development for SVA, and I'd like to welcome you to the second webinar in our 2024 dental series. This topic is Optimize Your Practice's Retirement Plans. Like I said, this is number 2 in the series. I will have more information on our future ones coming up at the end. But before we get started, I just want to take a sec and say a few words about SVA and our history in the dental industry. Actually, I know a lot of the same people that are attending today, this webinar, have attended our past webinar. So let me just say briefly, we're celebrating our 50th year this year. And one of the main reasons we've made it this long is because of our consistent goal of remaining independent. And by helping dental practices with profitability, growth, and overall business strategy, we help position them to remain independent as well. Our mindset is that when you're a practice owner or shareholder, you have to work with someone who's more than just an accountant or tax preparer. You need someone who's a true advisor working collaboratively with you. So anyway, that's my sales pitch. As far as this webinar goes, please send in any questions you have as we go, but we will wait till the end to answer them. If your question doesn't get answered, please reach out to me and I'll make sure one of our subject matter experts gets your question answered. So we've got 2 of the most experienced people in our healthcare and dental practice to walk you through everything today. First off, we have Laura Zock, who's not just a principal, but is also the leader of our healthcare industry group. And we have Joel Recklich, who's also a principal in our healthcare practice. He works with practice owners and practice managers on efficiency, tax, and profitability strategies. So let's jump right in. Laura, I'm going to kick it off to you.
Great. Thank you, Lee, for the warm introduction on this. Yes, unseasonably warm October day. We've got a great topic for us all today on retirement plans. And this is really a timely topic now that we're thinking about year-end, approaching ways that we can consider saving more money on taxes. The recruitment environment is always tough, so we thought this was a great topic to bring to the forefront of everyone's minds as we're going through some of the things. And the overview of what we're going to do today is talk a little bit more about why is this important now. And the Secure Act 2.0, which was enacted a couple years ago, and some of the main points about retirement plan updates that are going to be coming into effect in the near future with that. And then some considerations to selecting the right plan. Or if you already have a plan, it might be some considerations that make you want to change or consider elaborating on your plan a bit. We're going to go through some of the common and new plan types along with its key features, and then we'll wrap up with a couple tips on what you can do next to put this into action. So let's talk a little bit more about why is this so important right now. In the tight hiring market, any benefit that you can have for your employees is going to help set your dental practice apart in both recruiting talent and retaining talent. Aligning employees' interests with a retirement plan where you can help give them some of the profits, as that's the plan that you set up, can be a really beneficial thing. It's also important to think about what you can do now to help save for your future as well. Both dental practice owners and employees need to save money now for retirement down the road so that you have the ability to retire on your terms and live the kind of lifestyle that you want to have in retirement after working so hard. And one of the biggest reasons why we like retirement plans is the numerous tax savings involved with it. Retirement plans are honestly one of the best ways that you can save on taxes. You get tax deductions for the contributions. If they're traditional, your business gets a tax deduction for the contributions for your employees. All these contributions result in tax-deferred growth, or even if you select the Roth option, tax-free growth. So some really awesome ways to save money on taxes here. And then last but not least, the retirement world is ever evolving, ever changing. So it's really important to keep up with what's new on retirement plans so that you can ensure that the plan you have in place meets your needs of both you and your employees now, but also in the future as things continue to evolve. Or you might get some ideas on, hey, I don't have a plan. What plans should I put into place? So we're going to start today off with giving you some of the main pertinent updates that the Secure Act 2.0 put into play, which was passed a couple years ago, but many of the changes weren't going to come into play until later 2024 or 25, as Joel's going to give us more details on.
Thank you, Laura. Yeah, so like Laura said, Secure Act 2.0 did start a couple years back. The main thing that started with Secure Act 2.0 was the startup tax credit. There was a credit for administrative costs, employer contributions, and automatic enrollment. So if you haven't had a retirement plan started or have one in the first few years, you are available for these credits. So with Secure Act 2.0, the tax credit for the administrative expenses can be up to $5,000. And this is on 100% of those expenses over those first 3 years. With Secure Act 2.0, it's 100%. Previously, it was 50% up to the 5,000, which was a tough number to get to. Secondly, there is a credit for employer matching contributions. And this is up to $1,000 per employee. Yes, that's per employee. It does phase out over 5 years. And then you have the automatic enrollment. So if you set up automatic enrollment for new employees where they can automatically start deferring into their retirement, you can get a $500 tax credit. Over the last couple of years, I've had a few newer clients that started these different items, and they ended up with about $8,000 and $10,000 of credits just last year, and one of them was in their second year of existence. And then we have the expanded catch-up contributions. So if you're a higher earner, and that is going to be defined as wages over $145,000 in the prior year, you'll be required to make a Roth contribution starting in 2026. So first and foremost, review your plan. Does it even have a Roth component to it? If it doesn't, make sure it does, because if you don't, and it's tax year 2026, you will not be able to make those contributions if you don't have that Roth component. Secondly, for higher catch-up contribution limits, if you are ages from 60 to 63, you can have catch-up contributions of 150% of that regular amount. So for this year, if you have a 401k plan, it is the higher of $10,000 or the $150,000. If you have a simple plan, it's that $5,000 or 150% of that amount. These amounts will all be adjusted each year for inflation. Now let's look at some other changes that we have with Secure Act 2.0. We have the employer contributions eligible to be treated as Roth contributions. First, I was like, how do they even make this work? Because the employer wants that deduction for the matching contributions. How can they be treated as Roth contributions? So the reason why we don't have an effective date on this change is because the payroll providers will need to be adding this Roth employer match contribution as taxable income on the employee's W-2 if they make this election. Next, we have the simple and SEP Roth IRA. So starting actually last year, if you had a simple plan or a self-employment plan, you can start making Roth contributions. Again, you have to make sure your plan is eligible for those Roth contributions. And please don't forget to tell me if you're making that switch to a Roth, because you will have some major tax implications if you're making a switch from a regular to a Roth IRA. Now, starting in 2024, unused 529 plan funds in Wisconsin, that's like Advest, that have been maintained for at least 15 years can be directly transferred to a Roth IRA, tax and penalty free. So in addition to being able to get a subtraction on your Wisconsin return, and in 2024, that's up to $5,000 per person. And then if you're in the highest tax rate, you're looking at savings of almost $400 per person per year, in addition to any unused funds that are maintained for at least 15 years being able to go to a Roth IRA, tax and penalty free. It's just another way to get money into retirement. And then there's the employer matching for student loan repayment. Previously, employers could make loan repayments on behalf of the employee if the employee makes at least a 2% retirement for deferral, in addition to a 2% of their compensation towards loan repayments. Now, starting in 2024, the student loan repayments made by the employee will be treated like retirement contributions for the purposes of qualifying for retirement matching contributions for you. So this is just another way that employers can give employees more money into retirement. And a couple other items I'd like to discuss, the expedited long-term, part-term employee retirement eligibility. This is great because most plans have this 1,000 hour requirement for you to work in order to be eligible for our 401k plan. Sorry, everybody, my lights just went out here. So the eligibility is shortened to 2 years of at least 500 hours, starting with years beginning in 2025. And then the last thing I would like to discuss on Secure Act 2.0 is automatic enrollment. So beginning in 2025, employers will be required to enroll employees at a minimum of 3%. So previously, the employee, if they wanted to defer into retirement, they would complete a form saying, this is the amount that I want to put into retirement. Now the employee has to complete a form saying, I do not want to put any money into retirement. Now, this conservation rate that starts at the 3% will increase annually by 1%, up to 10%, but no more than 15%. Now, if you're a practice with less than 10 employees, you could be excluded from this, but I would still urge you to go with that automatic enrollment so you can be competitive with everyone else. So some initial considerations for selecting a plan. We'll be talking about a few different types of retirement plans, their advantages and disadvantages. So a few things that I like to think about are how much is the funding cost and the flexibility of that plan. You know, look at the demographics of the employees. You know, what is their age? What is their compensation? And then for you personally, like, what are your needs? Do you need to put more money in now? Did you get a late start? You know, look at those items. And then you can look at the resources to administer the plan. You know, the plan administration fees are a little bit out the window now. So if you're starting a new plan, you can get up to that $5,000 tax credit. So those should not weigh heavily into your decision-making. A few of the common types of plans, the new ones are called the Starter K, available this year. We have the Simple IRA and Roth IRA. We have the 401k plan with a profit sharing component. Then the cash balance defined benefits plan. Each one of these retirement plans has their own advantages and disadvantages. Let's take a look at the Starter K. So in my mind, the Starter K is perfect for those practices starting completely from scratch. So you have the ability to, the employees can start funding their retirement from day one and reduce their taxable income. The contribution is limited to $6,000, but there is availability for the additional catch-up contribution. One of the better features is there is no required matching contribution. And it does have the automatic enrollment at 3%. Now, as an employer, it looks attractive to employees because you have a retirement plan somewhere where they can start funding. In addition, it can help you retain employees because you do have that retirement plan. Now let's look at the Simple IRA. So a couple of key features about the Simple IRA. As you can see, the maximum deferral is much higher. It's $16,000 compared to $6,000 with the Starter K. The catch-up contribution of $3,500 if you're over 50 years old. But it does have a required matching of 100% of the first 3% deferred or a 2% profit sharing contribution. So what are some pros and cons of the simple IRA or Roth IRA? Well, a big pro is you don't have to file Form 5500, which is a reconciliation of your deferrals and match payments for the year. This brings down the cost, lower required employer contributions, and it's an easy plan to administer because you don't have the extra filings required. The downfall is, yes, you do have the $16,000 contribution threshold, but in a couple slides here, Laura will discuss ways to get a lot more money into retirement. The other item is it does have a required contribution for employees. Now, Laura will discuss the 401k profit sharing plans.
Yeah, thanks, Joel. We're definitely moving on from some of the more simple plans to some of the more complex plans here as we get through our webinar material. The 401k profit sharing plan is a plan that takes the ability for employees to defer their own wages, 401k contribution into a plan, but also couples it with the concept of employers providing a profit sharing amount along with that. So in these plans, we often see three different types of contribution types. The first would be that 401k deferral, which is a choice an employee can make to contribute part of their pay into the 401k profit sharing plan. The options in most plans tend to be pre-tax, where the employee gets the tax savings now, or a Roth deferral where they use after-tax dollars and don't save tax money on that deferral right now, but that contribution then grows tax-free in that Roth 401k. The other component is many of these plans have either an employer match or a non-elective contribution. This is the company deciding to make a certain percentage of a match of their 401k contribution into the employee's participant account in the company retirement plan, or they might be using a safe harbor formula where they're contributing 3% of the employee's compensation, regardless of whether the employee makes a contribution into the 401k. And then last but not least, there's that profit sharing component, which is discretionary or a choice that the employer can make at the end of each year on how much additional do we want to put into the retirement plan. What I love about this is the discretionary aspect of it, in that if your dental practice had a really booming year and you want to give more to yourself and your employees in terms of a retirement contribution and have some added tax benefits, you can elect to do a higher contribution in this year. Usually we help guide our clients on making those types of decisions when year end comes around and we're looking at their profitability, what their goals are, et cetera. All right, a couple other key features of the 401k profit sharing plan for 2024 is that the maximum 401k deferral is $23,000. This is a limit that the IRS sets each year. We typically see some inflationary adjustments, and usually the IRS is posting these annual adjustments right around now, like that late October or early November stage. I checked last night and they didn't have 2025 amounts posted yet. So the best we can go with right now is what we know for 2024. The IRS also allows for folks in these plans age 50 and over to do an extra contribution called a catch-up contribution as well. And that amount is currently $7,500. So right now, if we look at just what an employee can do into these plans, it's $23,000 plus $7,500, so $30,500. Next, then we consider what that profit sharing component is, or the safe harbor match. And that can be a substantial amount. That can be a contribution that takes the $23,000 of a 401k up to as much as $69,000 for a total contribution for 1 year for an employee in their profit sharing plan. When you factor in the catch-up that's allowed with this as well, you're looking at putting $76,500 away for retirement in a year, assuming that your compensation supports that. One thing that we do see with these plans is that with the ability to put more money away into retirement, there ends up being some added complexity in that there needs to be annual testing done for many of these plans to ensure that all of the rules and contributions are being calculated correctly and met. One of those things we need to look at is what's the compensation limit for each year, because your profit sharing contribution at most is calculated as a percentage of that compensation limit, which is a pretty high amount. For 2024, it's $345,000. So typically in a dental practice, it's the dentists that are reaching this compensation limit and potentially maximizing their contributions. Whereas if you think about it, your employees may be in that $60,000, $80,000, $100,000 range, depending on their position. Also, along with this testing comes the concept of the highly compensated employee. And this is something that's put into compliance to help ensure fairness in these plans, with the thought that we don't want a low income earner to be disproportionately disadvantaged when it comes to the company giving a contribution for that employee versus a high income earner for this. So always important at year end to go through the annual compliance testing and make sure that all of these non-discrimination tests are being met. All right, one of the ways that a plan can help make sure that they're staying on that compliance side and not failing the IRS non-discrimination tests is to implement a safe harbor option with this 401k profit sharing plan. And typically we see one of two things happen here for that safe harbor. Oftentimes it's a matching formula where the employer will match 100% of the employee's first 3% of their 401k deferral, and then 50% on the next 2%, which ends up being a contribution of 4%. Or they may decide to do a safe harbor non-elective contribution, meaning regardless of whether or not the employee contributes to the 401k, the employer is going to give a 3%, a minimum 3% contribution into that employee's account. What I love about these is that it helps employees save for retirement, and dental practices as the owner are getting tax savings for their company to make these contributions into those accounts. All right, moving on, a couple things on the profit sharing side then is when you're in the plan design process, you have the option on how to set up that profit sharing. And there's a number of different types of options that you can choose. Here's where your third-party administrator that's helping you explore these retirement plan options can be really valuable in giving you guidance and modeling out some of the different options on profit sharing so that you can see how much you as a dental practice owner are putting away for retirement in your own participant account, and what that cost is going to be for you to also fund your employees' profit sharing amount. A couple of the main contribution methods include a pro rata calculation. This is where everyone gets the same percentage of their compensation. So if you're a dentist and you make $300,000 and you're giving 4% in your profit sharing plan, that's going to be 4% of the $300,000. And then any employee that's eligible in your plan will also receive a 4% profit sharing on their compensation. There are also some more, I'll say, complicated models that can be used and might actually work out to your goals or your benefits or what you're overall trying to achieve with your plan. And integrated does give a greater percentage to those that earn over the Social Security wage base, so about $160,000. This tends to be a good option to consider when there is high earning younger owners, because age factors into all these compliance calculations. And then there's a cross testing where there's an allocation based on putting employees into different groups. And this might work out to the benefit of maximizing contributions when you have an older than average staff age. All right, now we're going to look at putting together some examples of how this all might look within participants within your plan. Here what I have on screen is an owner making $300,000 and an owner making $500,000, showing their maximum deferrals of $23,000. This is their 401k, and we're assuming we're under 50 in this example. A 3% match would then be an additional contribution for owner one of $9,000, a contribution of $10,350 for owner two. And then if we had a 3% profit sharing in place in this plan as well, that's another $9,000 and $10,000. So we're looking at the owners putting away $41,000 or $43,700 in this model. And then the employee examples I put down below just show us how the contributions might vary when you have someone contributing to a 401k or not contributing to a 401k. Employee 1 here is deferring $2,400 or 3% of their wages into the 401k, which then qualifies them for the match, which would be $2,400. And they're also required to get that profit sharing contribution of 3% here for a total of $7,200. Whereas employees 2 and 3, because they're not contributing their own wages to the 401k deferral, there's not a match calculated, but yet they must have that minimum profit sharing of 3% there. And then the next slide illustrates a little bit of the difference between the simple IRA plan, which Joel talked about, which is often a stepping stone retirement plan for many new practices. You can see here what some of those maximum amounts will be in this owner 1, owner 2 situation again, with the IRA contribution plus that 3% being about $25,000. Well, look at the column in the middle there, where if that was a 401k plan with a 3% match and 3% profit sharing, that owner's not putting away $25,000, it's $41,000. So some substantial differences here when you do choose to set up a 401k profit sharing plan versus some of the other options, particularly the simple IRA plan. All right, as we're getting close to wrapping things up, there's one more plan I want to talk about briefly, and that's the cash balance defined benefit plan. If you haven't heard about any of the plans on this call today, this might be the one that you haven't heard about. It's a plan that's been in existence for a while, but we're starting to see it become more popular now as employers are looking for ways to put vast amounts of money towards retirement and also have added benefits for their employees. So this is a type of plan that typically you would like to add on to or integrate with your 401k profit sharing plan. And it can allow for some substantially high contributions for owners and also provide a lower contribution for your employees as well. There are some situations that we've seen where with some older employees putting this into place, it might be that they can contribute another $100,000 or $200,000 pre-tax into these plans. So this is a particularly attractive option for dental practice owners that might be nearing retirement and really want to have some heavy additional contributions to go help fund their retirement. And all of these contributions are considered pre-tax, so there's some good tax savings with that as well. All right, whew, that was a lot to cover here. And you might be asking yourself, now what? What do I do next? So we've got a couple next steps ideas for you to help pull this together and think of some action items for you to take from our webinar thoughts today. First of all, I would say if you have a plan that's already in place, think back to all the updates Joel gave earlier on Secure Act 2.0 and make sure that you're connecting with your payroll provider and your third-party administrator to make sure that your plans are going to be in compliance and you can roll out those new or beneficially added features as that comes out. If you don't have a plan, hopefully this was some great information today to at least get you started on what your options might be and what the benefits might be to you and your staff, and also some of the substantial tax savings associated with it. You're going to want to partner with a great third-party administrator to help you model things out so that you can make choices on what kind of plan to put into place. Or maybe you have an existing plan and it's not exactly meeting your needs, and now you have some ideas on some of the additional things you could be doing. And their third-party administrator can help you with that. And your CPA tax advisor is also a good partner to have around the table when you have those conversations. All right, Lee, what's next?
Yes. What's next is questions. We only have a couple of minutes. Just so everybody knows too, we're in the process of a little bit of office remodeling, which means Joel is in a standalone office that he's not used to being in, and it has motion sensors. Joel, you weren't moving enough, so the lights went out on you. Sorry about that, everybody. That was funny. That's my old office, Joel. So I'm used to that. And then I used to have to like wave my hand to make sure it would go back on. Okay, we did have a couple questions come in. If you have any questions, please send them in now. We'll try and get to them real quick. Okay, so somebody asked, what do you think drives the selection process for most practices nowadays? Is it more based on what's best for the owner or what's best for the employees for recruitment retention purposes?
I'll answer that one. I'd say it's a little bit of both. I would say like 5-10 years ago when the hiring market wasn't so tight, it was, predominantly about, what can the owner do to save for retirement and also do some for the employees as well. But now as we've seen hiring become tighter, and plans are thinking about what ways can I do more to help my employees and recruit my employees, there is more thought given to what that employee contribution should be, as well as practices look to set themselves apart and also provide some unique benefits that maybe their competitors aren't doing in the marketplace.
Okay, yeah, and spoiler alert, at our next webinar, which I'll talk about here in a sec, we will have some statistics on what percentage of practices are offering retirement plans and what type of retirement plans, which can help for recruitment and retention purposes. Second question we had was somebody typed in saying, we've had a hard time finding someone that will help us with a startup 401k plan. What do you recommend?
I think Joel has some thoughts on that. He's helped some clients with that, so I'll have him answer that question.
Yeah, with the startup 401k plan, I mean, you're going to try to reach out to a retirement advisor. Sometimes these startup plans have a little trouble finding somebody that is willing to administer them because you're looking at lower funds going in initially. So that might be a little tough. We definitely know a few people. So if you do have any issues finding that person, please reach out to us. We'll set you up with somebody.
Okay, great. Well, not seeing any other questions and knowing we're over time, why don't we wrap up here? Laura and Joel, as always, great information, a ton of information to pack into a half an hour. So as we do wrap up, I just want to let everyone know that you can go to svaccountants.com to sign up for the other webinars in the series, and you can also find news and information that may affect your practice. So our next webinar that I just mentioned is November 14th. That's where we will review the results of our annual dental salary and benefit survey. So if you didn't participate, this will be the only way to receive the full results. So I really encourage you to sign up if you haven't already. And just want to remind everybody that the SVA team is only a phone call or an email away. So if you're a client, reach out to your SVA professional as questions arise. If you're not currently an SVA client, contact me, Laura, or Joel, and we can get you the help or the answers that you need. Thanks for attending today. Hope to see you at our next webinars and hope you enjoy the rest of your afternoon. Bye-bye.
Bye.
Bye.